Introduction to Accounts Receivables. Welcome to this course on Introduction to Accounts Receivable. In this course, we will be exploring the concept of accounts receivable and its significance in financial management. By the end of this course, you will have a clear understanding of what accounts receivable is, how it works, and how it can be effectively managed. Let's start with a basic definition. Accounts receivable, or AR, refers to the amount of money that a business is owed by its customers for goods or services that have been sold, but not yet paid for. AR is a critical component of a business's working capital, as it provides the company with a source of short-term funding that can be used to pay bills and make investments. So, how does accounts receivable work in practice? When a business sells goods or services to a customer, it sends an invoice that details the amount owed and the due date. The customer then has a certain amount of time to pay the invoice, usually 30, 60, or 90 days. The amount owed by the customer is recorded in the company's books as accounts receivable until it is paid. Managing accounts receivable is an ongoing process that requires regular attention and monitoring. Businesses must track the payments they are owed, and follow up on any overdue invoices in a timely and effective manner. This can be done through regular communication with customers, setting up payment reminders, and using technology such as invoicing software and payment systems. One of the key challenges of accounts receivable management is to ensure that customers pay their invoices on time. This can be achieved through a combination of proactive and reactive measures. Proactive measures include offering customers attractive payment terms and discounts, setting up automatic payment systems, and providing excellent customer service. Reactive measures include following up on overdue invoices, negotiating payment plans with customers, and, in some cases, taking legal action to recover the debt. Another important aspect of accounts receivable management is to minimize the risk of bad debts. Bad debts occur when customers are unable to pay their invoices, and the business is left with an uncollectible debt. To minimize the risk of bad debts, businesses can conduct credit checks on new customers, monitor their payment history, and be proactive in following up on overdue invoices. In addition to the measures mentioned above, businesses can also use various financial metrics to track and manage their accounts receivable. One of the most important metrics is the accounts receivable turnover ratio, which measures the speed at which a business is collecting its accounts receivable. A higher accounts receivable turnover ratio indicates that a business is collecting its accounts receivable faster, which is generally a good sign. In conclusion, accounts receivable is a critical component of financial management that can help businesses improve their cash flow, reduce their cost of borrowing, and make better use of their resources. By effectively managing their accounts receivable, businesses can ensure that their customers pay their invoices on time, minimize the risk of bad debts, and improve their financial health. We have now covered the basic concepts of accounts receivable and its importance in financial management. In the next section of this course, we will be exploring accounts receivable in more detail, including the different types of accounts receivable, the role of credit management in accounts receivable, and best practices for managing accounts receivable. I hope you have found this introduction to accounts receivable helpful, and I look forward to continuing our exploration of this important topic in the next section of this course. Thank you for watching. See you at the next section.